Hello, esteemed listeners and investors. Welcome to the Deep Macro Lens podcast, where we delve into the hidden undercurrents shaping global macroeconomics, geopolitics, and finance. I'm Ryan Oliver, and with over 20 years of in-depth experience analyzing economic cycles, financial crises, and central bank monetary policies, today we're stepping into a silent yet fierce battle, rarely discussed in mainstream media, the covert currency war, where nations, particularly economic powerhouses, are debasing their currencies, not through direct announcements, but through seemingly innocuous policies, with the ultimate aim of saving their own economies. In a challenging global economic landscape marked by persistent inflation, sluggish growth, and recession risks, central banks and governments are constantly searching for solutions. And one of the most powerful tools, albeit controversial and rarely openly admitted, is manipulating the value of their currency. But why do they do this? What are the consequences? And what can we as ordinary citizens do to protect our assets in this silent war? First, let's be clear. Currency debasement isn't just about a government openly declaring a devaluation. In the modern era, it's far more sophisticated. There are three main mechanisms nations often employ for covert debasement. Super loose monetary policy. This is the most common method. When a central bank maintains record low interest rates for an extended period, or implements massive quantitative easing, QE programs, essentially printing money to buy assets, they are increasing the money supply. This, over time, reduces the real value of the currency. Detailed explanation. The mechanism is quite simple. When domestic interest rates are lower than in other countries, foreign capital is less attracted to flow into that nation due to lower yields. Conversely, domestic investors tend to seek higher returns abroad. Both factors reduce demand for the domestic currency, causing its value to fall relative to other foreign currencies. As the currency weakens, the nation's exported goods and services become significantly cheaper for foreign buyers, thereby boosting demand and enhancing export competitiveness. Conversely, imports become more expensive. Examples. Consider Japan and Abenomics for many years, or the European Central Bank, ECB, with its prolonged negative interest rates. The goal is to weaken the yen, or the euro, making their exports more competitive. Under Shinzo Abe, Abenomics' three arrows policy, aggressive monetary easing, fiscal spending, and structural reforms, pushed the Bank of Japan, BOJ, into an unprecedented quantitative easing program. The BOJ dramatically expanded the monetary base, causing a significant depreciation of the yen. For instance, from December 2012 to May 2013, in just 6 months, the Japanese yen fell by as much as 22% compared to the US dollar, from roughly 82 to 100 yen per dollar. This depreciation significantly improved the price competitiveness of Japanese manufacturing exports in the global market, closing the gap with competitors like South Korea. Similarly, the European Central Bank, ECB, first cut its deposit rate below % into negative territory in June 2014 and continued to cut it further, reaching 0.5% by September 2019. The objective was to encourage commercial banks to lend to the economy rather than hoard money at the ECB, and one of the desired effects was to weaken the euro. When interest rates are lower, especially negative, euro-denominated assets become less attractive to foreign investors, reducing demand for the euro and pushing its value down. A weaker euro, in turn, helps Eurozone exporters become more competitive in the global market. The Federal Reserve also injected trillions of dollars into the system during and after the pandemic. While ostensibly to support the economy, the indirect effect was to reduce the purchasing power of the US dollar. Direct FX intervention. Although less overt, some nations still use their vast foreign exchange reserves to buy foreign currency and sell their domestic currency, aiming to keep their currency's value low. Example. China has often been accused of manipulating the yuan's exchange rate to support its exports. While they deny it, maintaining a stable yuan exchange rate amidst significant fluctuations in other currencies is often indicative of intervention. Debt-funded fiscal deficits. This is a mechanism that mainstream media rarely calls currency debasement, but in essence, it serves a similar purpose. When a government consistently spends more than it collects in revenue, meaning it runs a budget deficit, it must cover that shortfall by borrowing heavily. This is typically done by issuing government bonds. Detailed explanation. The problem arises when the central bank, in order to keep the government's borrowing costs low, prevent bond yields from rising too high and increasing the debt burden, is compelled to buy a large portion of the bonds issued by the government. This bond buying is often done by printing money, in essence, creating new money within the financial system. When a large amount of new money is injected into the economy without a corresponding increase in the production of goods and services, it leads to inflation. Inflation, at its core, is a form of invisible tax. Instead of the government directly taking more money from citizens through explicit taxes, the purchasing power of the money in their pockets is eroded. This benefits the government because it reduces the real value of the public debt, meaning the amount of debt the government borrowed in the past, when repaid with a debased currency, has a lower real value. This is a covert way to reduce the debt burden without having to implement harsh austerity measures or openly default, but it comes at the cost of quietly eroding the wealth of the populace. Example. Consider the case of the United States. The U.S. national debt has now surpassed a record $36 trillion and continues to grow. This massive debt is funded by continuous bond issuance. In the post-pandemic period, when U.S. inflation surged, peaking at 9.1% in June 2022, many independent economists argued that the massive fiscal spending by the government and the Fed's prolonged low-interest rate policy to facilitate debt financing contributed significantly to this inflation. While not a direct debasement policy by the Treasury or the Fed, persistent inflation has eroded the purchasing power of the U.S. dollar, a covert way to reduce the government's debt burden without citizens fully realizing it. This is a strategy often seen when nations want to escape mounting debt without facing the political repercussions of raising taxes or cutting spending. So, why do nations risk implementing these policies? Simply put, because they believe it will save their economies, boost exports and support growth. A weaker currency makes a nation's goods and services cheaper in international markets, thereby boosting exports, creating jobs, and supporting domestic economic growth. This is the primary reason nations engage in this competition. Example. Germany benefited significantly from a weaker euro against the USD in the past, making its industrial products more competitive. Similarly, a Japan with a weak yen boosts the profits for major export corporations like Toyota and Sony. Debt devaluation. This is a less talked about but extremely crucial reason, especially for nations with massive public debt. When a currency loses value, the real value of the debt, denominated in the domestic currency, also decreases over time, making it easier for the government to repay its obligations. Detailed explanation. Imagine this. If the government borrowed $100 billion in 2020, and by 2025, due to inflation, the purchasing power of that $100 billion has decreased by 20%. When the government repays that $100 billion in 2025, it effectively has the purchasing power of only $80 billion from 2020. This acts like an automatic discount on the government's debt. It's particularly effective for long-term debts, where inflation has time to eat away at the real value of the principal. However, this is a sophisticated way for governments to steal wealth from their citizens through inflation. Instead of openly raising taxes, which could cause a negative reaction from voters, or implementing painful austerity measures, which could have social and political consequences, governments choose the easier path of allowing their currency to debase. When the currency loses value, citizens' savings held in cash or low-interest assets see their purchasing power evaporate. In essence, citizens are indirectly funding government debt without even realizing it, because the real value of their assets is quietly diminished. Combating deflation. In some cases, especially in economies stuck in prolonged stagnation like Japan, currency debasement is a desperate attempt to escape the deflationary spiral. Deflation is a situation where the prices of goods and services continuously decrease. Detailed explanation. While falling prices might sound good, deflation is extremely dangerous for an economy. When prices fall, consumers tend to delay purchases, expecting prices to drop even further. This reduces aggregate demand, causing businesses to cut production, lay off workers, and reduce investment. A negative feedback loop forms: falling demand, reduced production, job losses, reduced income, falling demand. In a deflationary environment, the real burden of debt actually increases because the borrowed amount remains fixed, but the value of assets and income declines. By debasing the currency, imports become more expensive, and this can help push domestic prices up, creating some inflation, also known as reflation. The goal is to break the deflationary expectations of consumers and businesses, encouraging them to spend and invest now rather than waiting, thereby stimulating economic activity. Example: Japan grappled with deflation for decades after its asset bubble burst in the early 1990s. Abenomics, with its aggressive monetary easing and yen weakening policies, was a direct attempt to escape this deflationary trap, aiming to bring inflation back to a 2% target and stimulate economic growth. But who pays the price for this war? None other than ordinary citizens and importers. Consumers face rising prices for imported goods, imported inflation, and the erosion of their wages and savings purchasing power. Their currency might be strong nominally, but weak in real terms. Importers face higher input costs, impacting profits and sometimes forcing them to pass the burden on to consumers. Global instability. When too many nations try to debase their currencies, it can lead to a race to the bottom, causing instability in the international financial system and potentially igniting trade wars. This covert currency war shows no signs of stopping. In a fiercely competitive global economy, each nation will continue to seek ways to protect its interests, and currency manipulation will remain an attractive tool. Outlook for the USD. Although the US dollar has strengthened significantly in recent years due to the Fed's higher interest rates and its safe haven role, in the long term, with massive public debt and undisciplined fiscal policy, the USD is at risk of gradual weakening. This will be a slow process, not a sudden collapse, but rather a gradual erosion of purchasing power over time. Mainstream media often only looks at the DXY dollar index against other major currencies. But what we need to look at is the real purchasing power of the US dollar against tangible assets, like commodities, real estate, and gold. The euro, Japanese yen, and British pound will continue to face pressure as their central banks must balance fighting inflation with supporting growth, often leading to hesitation and aggressive rate hikes. The de-dollarization trend and the rise of blocs like BRICS Plus with intentions to create common currencies or separate payment systems will continue to challenge the USD's dominance, although this process will be very slow. So, how can you protect your assets in this silent currency war? Diversify into hard assets. Gold, silver, real estate, especially in stable economic regions, and basic commodities are assets with intrinsic value that cannot be print. They serve as an insurance policy against currency debasement. Consider crypto assets. Bitcoin, with its decentralized nature and limited supply, is considered by many as digital gold and a hedge against inflation and fiat currency debasement. However, it's a highly volatile asset and requires careful consideration. Invest in businesses with pricing power. Look for companies with strong financial foundations, stable cash flows, and reasonable valuations that can easily pass on increased costs due to inflation and currency debasement to consumers without losing market share. These are often companies with strong brands, monopolistic positions, or essential products. Avoid holding excessive cash. In an environment where currency is constantly losing value, holding too much cash in bank accounts is a risk. Seek to convert it into assets with inflation hedging and growth potential. Consider international markets. If your domestic currency is being manipulated or weakening, diversifying investments into markets with more stable currencies or assets denominated in stronger currencies can also be a strategy. The covert currency war is an ongoing reality, influencing many macroeconomic decisions globally. It's not just a story of governments and central banks, it directly impacts each of our wallets. With 20 years of market analysis experience, I believe the most crucial thing right now is to equip yourself with deep knowledge and an independent perspective to identify the signs, understand the motives, and thereby make intelligent decisions to protect your wealth. Never blindly trust what mainstream media tells you. Dig deeper and analyze for yourself. Thank you for listening to Deep Macro Lens. If you found this content useful and wish to continue receiving in-depth, unbiased analysis of the global economy and finance, don't forget to subscribe and share our channel. See you next time.